5-Step Guide to Winning Forex Trading, Part 2. Winning Forex Trading Step Number 5. Place stop-loss orders at reasonable price levels. This axiom may seem like just an element of preserving your trading capital in the event of a losing trade. It is indeed that, but it is also an essential element in winning Forex trading. Many novice traders make the mistake of believing that risk management means nothing more than putting stop-loss orders very close to their trade entry point. It's true that part of good money management means that you shouldn't put on trades with stop-loss levels so far away from your entry point that they give the trade an unfavorable risk-reward ratio, i.e., risking more in the event the trade loses than you reasonably stand to make if the trade proves to be a winner. However, one factor that frequently contributes to lack of trading success is habitually running stop orders too close to your entry point, as evidenced by having the trade stopped out for a loss, only to then see the market turn back in favor of the trade and having to endure watching price advance to a level that would have returned you a sizable profit, if only you hadn't been stopped out for a loss. Yes, it's important to only enter trades that allow you to place a stop-loss order close enough to the entry point to avoid suffering a catastrophic loss. But it's also important to place stop orders at a price level that's reasonable, based on your market analysis. An often cited general rule of thumb on proper placement of stop-loss orders is that your stop should be placed a bit beyond a price that the market should not trade at if your analysis of the market is correct. Example. As an example to help you better understand this concept, consider the following two charts of AUS/USD, which look at the market price action on August 31, 2017. A trader looking at the 5-minute chart below might have entered a buy order around the 0.7890 price level, indicated by a red up arrow shown just above the medium-length blue candlestick that appears just above the word level on the left-hand side of the chart, based on the candlestick closing with the price above the two moving average, red and blue, lines plotted on the chart. The trader might also have chosen to place a very close, very low-risk stop-loss order just below the recent lows around the 0.7880 level, as shown by the horizontal red line drawn on the chart. Unfortunately, the subsequent price movement, just left of the center of the chart, just to the right of the word low, would have stopped him from the trade before there was a substantial price movement in his favor. The resulting loss would have been minimal, so to that extent, the trader can be said to have practiced good risk management. However, as the price action on the right-hand side of the chart clearly shows, after the trade was stopped out, price, in fact, turned sharply upward. If the trader hadn't been stopped out, he could have realized a very nice profit. It may appear at first glance that the stop-loss was placed at a reasonable level in being placed below recent lows that appeared to show some amount of support. Just before the trade was triggered, several candlesticks in a row showed price holding above the 0.7880 level. But was that truly a reasonable place to put the stop-loss order? An examination of the market's price action as viewed on a higher time frame, the 4-hour chart, clearly reveals that the answer is no. Looking at the 4-hour chart shown below, it seems fairly clear that price might have dropped to as low as around the 0.7870 level, support area again indicated by the horizontal red line drawn on the chart, without violating a potential scenario of price moving higher since the price had dipped to around that 0.7870 level before finding buying support several times in the preceding 2 weeks of trading. Had the trader extended his market analysis to looking at support levels on the longer-term time frame rather than just on the 5-minute chart he was basing his trade on, then he might have chosen to place his stop at the more reasonable support level about 10 pips lower, below 0.7870. Yes, he would have been risking slightly more money on the trade, but still not any dangerously large amount. In fact, as things turned out, he wouldn't have suffered any loss at all. Instead of having been stopped out for approximately a 10-pip loss, he would have realized a very nice profit, with a good chance of the market moving even higher in his favor. Placing stop-loss orders wisely is one of the abilities that distinguish successful traders from their peers. They keep stops close enough to avoid sustaining severe losses, but they also avoid placing stops so unreasonably close to the trade entry point that they end up being needlessly stopped out of a trade that would have eventually proved profitable. In short, a good trader places stop-loss orders at a level that will protect his trading capital from suffering excessive losses. A great trader does that while also avoiding being needlessly stopped out of a trade and thus missing out on a genuine profit opportunity. Forex trading conclusion. Like any other investment arena, the Forex market has its own unique characteristics. In order to trade it profitably, a trader must learn these characteristics through time, practice, and study. Traders will do well to keep in mind the helpful tips for winning Forex trading revealed in this guide. Pay attention to pivot levels. Trade with an edge. Preserve your trading capital. Simplify your market analysis. Place stops at genuinely reasonable levels. Of course, that isn't all the trading wisdom there is to attain regarding the Forex market, but it's a very solid start. If you keep these basic principles of winning Forex trading in mind, you will enjoy a definite trading advantage. We wish you the greatest success.
Friends, thanks for watching. Please subscribe my channel for more videos.